Talk more about it. Steve, stay with us. So are they a negotiating tactic or actual policy that we should expect? Let's ask Tobin Marcus. He's head of policy and politics at Wolfe Research. Tobin, what's your base case?
So I think we're going to see a mix of both. I think when we look at the Canada and Mexico tariffs, those look very much like a negotiation tactic. You know, he's trying to pressure them to take action on migration and drug trafficking, where the trends are already heading in the right direction. It looks like a classic case of a situation where you can make some token concessions, everyone can take a win and go home without anything catastrophic happening. When we look at China, I think that's a very different situation. You know, we may also see efforts to negotiate. Certainly, I do think it's going to be appealing to President-elect Trump to try and have a big, high-profile sit-down with President Xi sometime next year. But you know, there I think there's a lot more resolve across the Trump administration to go ahead and do something real on tariffs that really affects revenue and really affects global trade flows. So
do you have kind of a numbers case if you think the Chinese tariffs, and you're talking about the 10% tariffs, right? How does that compare with what we did the first administration? I think the effective tariff rate on China now is what, like 13%, something like that?
Yeah, right now the effective tariff rate on Chinese imports is a little bit north of 10%. You know, in our base case, that's going to somewhere in the 30% range. So substantially up. You know, he could do this 10% across the board that he's threatened through IEEPA, and then a bit beyond that and get us there. But, you know, I think there's going to be a lot of differentiation across product types, as we saw in 2018 and 19. It's not going to be a flat 30%. It's not going to be a flat 60%. You know, we're going to see some of the items that are less directly visible to consumers in terms of intermediate inputs, in terms of industrial machinery, likely once again facing higher rates than consumer goods.
You know, this debate was put towards to Matthew Shea, head of the National Retail Federation, where he made some interesting comments about the differences between the first round of tariffs for retailers and what might happen today. Here's what he told Money Movers.
Retailers have lived with tariffs for the last 7 or 8 years. Both because of tariffs that were imposed, but also just disruptions to the supply chain have changed the way we source and supply things. And I think people would be surprised to know, for example, on importing from China things like apparel and accessories, we import 40% less today than we did in 2018. So retailers have moved away from China for many of the things they're sourcing.
Does your data jibe with that, Tobin?
Yeah, that's absolutely true. The effect has been more pronounced on the categories of goods that have faced higher tariff rates. So again, things like machinery, computer equipment, intermediate inputs, than it has been on the consumer side. But there have been declines in U.S. imports from China on both sides. Even within the consumer category, there's been differentiation. You know, for the most part, the highest tariff rate that those kinds of goods have faced is 7.5%. But many of them never got hit. They were in the sort of final tranche of tariffs that Trump threatened before Christmas 2019 and then called off when he reached the phase 1 trade deal with China. So there's a lot of room to the upside. You know, those numbers have fallen, but they have not fallen to zero, and we could see further redirection.
Steve, what would you add to that?
I'm afraid Tobin is looking at this through the rose-colored glasses that a lot of people on Wall Street are looking this under. And I'll offer the following argument, which I understand is up for debate. President-elect Trump has a very ambitious domestic agenda that includes tax cuts, increasing corporate tax cuts, individual tax cuts, a bunch of spending, and other tax cuts on things like tips and things like that. He also has a part of his party that is concerned about the deficit. He's going to need revenue in order to get any of this domestic agenda through. And for that, he has pegged and noted that tariffs are a source of revenue. And if they're a source of revenue, I do not see how they can simultaneously be a source of negotiation. In that, if you count on them for revenue, you can't negotiate them away at the negotiating table. So that's the rub. I don't quite get how that squares. Now, maybe the domestic agenda goes away, or it's not paid for, or these become revenue measures that are not subject to negotiation.
How much would they potentially raise, Tobin?
So, you know, in this sort of upside case, if you were to do a 60% tariff on China and a 10% global tariff, which is well beyond what we think will happen, that raises somewhere in the neighborhood of, $2.5 to $3 trillion, which would be enough to cover over 10 years. That's right. So, we're looking at somewhere south of that. I think a gesture in the direction of revenue from tariffs is going to be part of the plan for Republicans to explain how they're paying for their tax bill next year. But my suspicion would be that they're not actually going to legislate those tariffs in a way that forecloses Trump's flexibility on them. I think we're going to end up with a tax bill that does have a significant deficit price tag attached to it did some real pay-fors in terms of partial IRA rollback, probably some Medicaid savings, student loan reforms. I think there are other places they can go for savings. And then for the balance, they'll point to the revenue from tariffs.
Yeah, Steve,